Hello and welcome to Leviathan News. It is October 12th, and we got a full slate of topics to talk about today. We're joined by Wormhole from the Llamarisk team, and then we also have Atomist coming back to help us with some Arbitrum updates. So welcome both of you.
Hey guys, yeah, pleasure to be here.
Yeah, thanks for having us on.
So Wormhole, this is actually your first time here. Castle Cap,
Yep.
Atomist, you're back again for your second time. Wormhole, you run the Llamarisk team. Maybe you can talk a little bit about what you're doing over there, just so people kind of have an understanding of the great reports that you guys are putting out.
Yeah, so I guess just a little background about Llamarisk. We started in late 2021, and it was really a community-led grassroots kind of organization that came out of Curve in response to a particular incident. It was Mochi USDM, which was a bad actor, pretty definitively. Everybody in the community sort of agreed that this was improper behavior, and they were doing some things where they were passing votes based on offering airdrops or bribes to people. And in the aftermath of that, we sort of realized we need to have a group that's dedicated to kind of looking into different protocols that are integrating with Curve. And so Llamarisk sort of emerged, and over the years we've developed into like a really great team. So we're probably about half a dozen analysts now, and we're on a regular basis. We're interfacing with the different DAOs and protocol teams that have pools on Curve and are integrating with Curve in different ways. We're trying to keep Curve's LPs safe. We're trying to make sure that DAO voters for Curve know what they're voting for. So give everybody transparent information as much as possible. And I think today we're going to be talking about tangible USDR, which was one of the protocols that we reviewed earlier this year, earlier in the spring this year.
Yeah, so actually we are going to talk about USDR today. So yesterday there was we actually reported this on stream that Tangible's USDR had depegged. It had fallen off. It had come down from $1 all the way down to about 50 cents. And it had done it in quite a quick fashion. And essentially the protocol had run out of DAI reserves. And just to back up a little bit, and let me bring up the screen here. Tangible's USDR was a RWA-backed stablecoin where it was a mixture of both DAI and some other protocol-owned liquidity, plus a little insurance fund, but mostly backed by real estate. And the idea was that real estate is a yielding asset. And in their words, over time, the price of real estate goes up. So it should be a quote unquote inflation resistant stablecoin, and what they called better money. They had it so that all USDR was redeemable for DAI at all times with a 25 basis point fee. And they expected that they had enough capital buffer to facilitate redemptions and prevent a bank run. Well, that was the case up until yesterday, when 12 million DAI was taken out of the capital buffer, and then there was nothing left. So people started dumping USDR on the open market, and the price has crashed. So if I bring up this picture before we go into the Llamarisk, you can see that the collateralization yesterday was made up of four things. So the real estate constituted about 60% of the value of USDR, followed by a mixture of protocol-owned liquidity, including USDR itself, that constituted about 23%. Then they had an insurance fund of about $6 million, which it was another 10%. And then on top of that, they claimed they were over collateralized because of their governance token, which added on another $13 million. And so all of this kind of collapsed, right? Because as soon as the DAI was gone and the insurance fund had been tapped out, really there was nothing left except for the real estate, which is now being held, and then also their governance token, which can be assumed to be worthless. And now the real estate is going to either have to be divvied up between the holders who are left, or it's going to have to be sold off probably at a discount, and they're going to have to pay taxes on that as well too. So that will have to be discounted significantly lower than what it is now. We had a great thread by Wismerhill, and he had this nice little thing here. Let me see if I can make this a little bit bigger. I can't make this bigger, but he essentially had fair value of USDR at 29 million, which was where the 50% price is right now. And the reason that we wanted to have the Llamarisk team on today was that back in April, you guys had done a very expansive report into USDR. And I'm just going to scroll down here to the bottom. It's a very good report, goes very deep into how all the contracts work. But the conclusion towards the end was that, and I'm going to quote here, Tangible has several built-in mechanisms to support the peg of USDR. They have conceptualized a promising method to assure that USDR holders can always redeem USDR for something of equal value. However, most measures are still new and not battle-tested, and some are fully centralized. Especially in the case of a bank run, it's questionable whether USDR can hold this peg. Moreover, the project introduced multiple dimensions of additional complexity and potential weakness through its WUSDR token and multi-chain integration. These factors do not contribute to the safety of USDR's peg stability. And we'll just leave it there. So very prescient to what happened yesterday. It's too bad nobody listened, and they amassed $65 million before losing the peg.
Yeah, that's a really thorough introduction to the whole USDR saga. This was a very interesting one to cover because the project that they've built isn't really a fork of anything else. So it is really quite a unique project that took a lot of building blocks from other successful flywheel strategies, such as FRAX's AMO. It has algorithmic components. When you look at the backing composition of USDR, they emphasize the real estate backing, but you can see by looking at it, it's composed of a bunch of different things: the POL, the protocol on liquidity, the DAI, and Tangible, their own native token. So it's partially endogenous. So they've tried to construct a system that would be able to be liquid in all foreseeable circumstances. Although the fact of the matter is that their real estate backing is a very illiquid asset class. Anybody can see that. And if it push came to shove and they had to liquidate, it's going to be a difficult process. It's going to take a long time. And it would probably lead to some kind of situation like we experienced recently, where there was a serious depeg and there wasn't really any immediate way to arbitrage it or to alleviate the situation.
Yeah, they're essentially a REIT, real estate investment trust, that is issuing a liquid debt token at near 100% LTV with extreme duration mismatch. And we don't even have to look in crypto to see where these issues have risen before. I mean, we only have to go back 15 years to 2008 when we had this exact sort of issue happen within banks, right? And even in Silicon Valley Bank just a couple of months ago, we had a similar situation, but on a different type of asset. Or actually, I think Silicon Valley had quite a lot of mortgage-backed securities on their books as well too. But the thing that I've learned from stablecoins, and I think this was echoed by the blue chip team in a tweet that they put out today, is that if there is any sort of illiquidity on a stablecoin's balance sheet, it exponentially raises convexity and risk. And if there is any possibility of a bank run that will happen in the future, people are always going to find it and exploit it, because they understand the money that can be made and also the risk that's there, and that they need to be the first ones out so that they're not bag holding like everybody who's left over holding the USDR tokens today.
And just to give credit to the Tangible team, this was not a risk that they were hiding. This is something that they directly said was a possibility, even back when they were making their gauge proposal on Curve. They disclosed that not only was this a risk, but it was something that had happened before. So back in March 11th, when all the world was falling because USDC was insolvent for a weekend. A lot of other stable coins were affected, and USDR was one of those. And during that event, and I'm just reading off of the proposal that they made to Curve for a Curve gauge. They saw redemptions of USDR for all of the DAI in their reserve until there was no more DAI left. They were on the verge of requiring to issue PDAI, which is their IOU for in the future when we have come up with the liquidity, we can pay you back one DAI for one PDAI. So there was discussions at the time that we're going to have to mass issue PDAI in order to maintain stability and create a PDAI DAI market, so it's liquid, people can trade in and out of it. But ultimately, that ended up being a very short-term issue that was resolved, by the next week. So they never ended up having serious repercussions from that event. And I think they got a slide because there were a lot of stable coins that were affected, and it wasn't primarily a USDR related issue at that point. But it did show that this was something that could happen, and it in fact did happen.
Yeah, and you had also had a thread on the forum. This was shared to me by Dio yesterday about pausing the USDR AM3 curve gauge on Polygon. Whatever happened with that vote? Did they pause those emissions?
No. So when I made this proposal, I was trying to be very cautious to slowly kind of seed this idea that we weren't comfortable with the level of risk presented by USDR. And I didn't want to immediately put a vote on chain and kill the gauge. And the reason for that is because at the time, USDR was very, I don't want to say dependent, but their strategy revolved heavily around bribing their USDR 3-curve pool. I think it was paired with 3-curve. On Polygon. So they were bribing somewhere in the order of $100,000 to $160,000 a week in that pool. And if we were to kill the gauge on them, they would have spent all that money, and we would have been like, okay, we're rugging you for everything that you spent on it. I had reservations about where the money was coming from that they were using for bribes. I've never really gotten to the bottom of that completely, but since I knew that it was such a big part of their strategy to have this curve pool and incentivize it, we needed to kind of gradually roll out the idea that we weren't so happy with it. And so that proposal was part of the kind of let the DAO know what we've found and what we're concerned about, and to give the Tangible team a heads up that was the direction we were moving in. Ultimately, this proposal never went to a DAO vote because the Tangible team, of their own accord, decided to move their liquidity to another exchange. I think that as a result of what they perceived as hostility, and I think, to be fair, we were kind of hostile towards them. Not that we had animosity towards the team or anything. We were really looking out for the well-being of Curve LPs in the DAO. But we couldn't get around the fact that, it was sort of a hostile action to take to try to push a protocol off of Curve.
Well, in hindsight, it was the right thing, right? Because, maybe you can get into a little bit more about, like, when you talk about trying to keep LPs safe through these curve gauges, you could have killed the gauge. They could have still remained on Curve. So like, what's like the ultimate outcome that you're trying to use with these Llamarisk reports? Is it just to like stem the flow of incentives from the like the curve DAO itself, or is it to prevent LPs from taking undue risk and leaving them in a situation like they are now today with USDR?
Well, I think ironically, our goal with our reports is more to build stronger relationships with these teams that we're reviewing. So it doesn't seem like it, maybe because we often take a critical view of the protocols and their design and the risk vectors that we find within them, but actually we're trying to use this as an opportunity to build a dialogue with these teams, to help them see what maybe from a certain bias, it's their baby, they built this thing, so maybe to give them an outside perspective, we can help them to see what the weaknesses are. And most of the time we do actually have a really warm experience working with these teams. You might not think it, considering like the angle that we're coming from, but with our reports, we're trying to build stronger relationships between Curve and these other protocols. In this case, that didn't exactly happen, unfortunately, because of what we perceive to be an undue level of risk inherent to the protocol design. And so in this case, our primary goal was make sure that everybody knows that this is an undue risk. That's our primary motivation. And then anything beyond that becomes a matter for the DAO to decide what's appropriate to deal with.
Yeah. So just to wrap up on the tangible stuff, to talk about what the team is doing next, the USDR stablecoin is now 84% collateralized. If they mark the tangible token and the insurance fund to 0, they do have some protocol and liquidity left, but that is primarily in USDR. They're going to be transferring all of their real estate into what they call baskets, which are like essentially pools of real estate that they're going to distribute out to USDR holders on a pro rata basis. If there is no demand for these real estate tokens, they will start to sell off their property and then return funds back to USDR holders. The USDR token is going to be deprecated and will no longer be used, and the tangible team wants to focus on just tokenized RWAs going forward. So yeah, well, it's I mean I just get a little incensed at these situations just because this is the type of like easy ammunition that we give to regulators to point and say, hey, look, like, this, like, regulations would have solved this. We could have presented this. This definitely wasn't a stable coin, and I don't know. It's just a little frustrating.
Before
before
we oh, go ahead.
No, go ahead, Garrett.
Oh, before we wrap up on this, are there other pools that you and the risk team have your eye on, like pools that you think might be one of these like warning signs that LPs are ignoring that you'd like to take the moment to like warn people about?
Well, I suppose the one that immediately comes to mind is I think that they just recently did a gauge vote. It's the staked USDT pool. I don't want to say that it's that it's bad and you should stay away from it, but I would want to emphasize that there's very, very little known about the team that's operating it, which has there's a high level of trust associated with the team. All of the off-chain components. So sorry, just to back up a second, what staked USDT is, it's a real-world asset protocol. So you deposit stablecoin and you can mint staked USDT. And then that stablecoin that you deposited is offboarded and then that is used to buy short-term treasury bonds, according to the team. But there's very, very little information out there about what happens to your money once it's offboarded. We know it goes to Huobi, and then because we can see that on chain, but then after that, there's no information about the legal arrangements, the custodians, what kind of assets are actually being purchased with your money, and what kind of legal rights you have to recoup your money afterwards. So when you want to redeem. So I would just say be very cautious about this. We've been looking at several real world asset issuers, including Ondo, which issues USDY most recently. We've looked at Matrix Stock, which issues STBT. And these issuers we find put a lot of emphasis on trying to be regulatory compliant and give as much information as possible to their users. By comparison, when we look at staked USDT, it's a black box. So I would just be very cautious about putting your money into anything that is a black box.
All right, so let's move on to our next topic for today, and what we have Atomist from Castle Capital here to talk about, and that's the Arbitrum voting. We are 11 hours and 34 minutes at the time of this live stream from ending, and overnight a bunch more votes came in. I think yesterday we had on OX Saitama from Dopex, and they were sitting at 160 million votes. Now they're breaking almost 200 million votes, with many more projects now passing. We have a current allocation of 72 million Arbitrum, which is 22 million over the proposed cap. So Atomist, maybe you can walk us through like what happens when we get to the end and we have, I don't know, 80, 85 million ARB that's been allocated out for this first round of STIP grants.
Yeah, that's right. I just shared a link to you guys on the side as well. Maybe if you want to push it on
Sure.
the comments or open that. It shows how the cutoff works. But yeah, essentially now we have a way oversubscribed 4 votes. So we're currently at about 70 million of ARB has passed already. And only 50 million can go through. So essentially how that works is only the most projects with 4 votes are being cut off here. So yeah, as you can see, the current cutoff is 111 million 4 votes. So the problem's not about quorum anymore, like we thought it might be at the start. We've got lots of teams at quorum, but now we're seeing, yeah, it's just who can get as many 4 votes as possible.
Interesting. Yeah, there's a lot of like bigger projects that have just probably won't make it at all. I mean, looking down here, Lido is below the cut, Ramses, and also Synapse as well too. So
yeah, definitely. I mean, we've seen some controversy around some protocols here and there. Lido themselves actually came out with a 12-month proposal, even though it was a 3-month program, and even after receiving that feedback, still didn't change their proposal. So if they had made a 3-month proposal, I'm sure they would have got a lot of support, and the support that they have got, is still pretty good, because obviously people want staked ETH on Arbitrum.
Yeah, when I look at this list, it really shows the kind of core Arbitrum products. Like when I think of the Arbitrum, the brand, like the protocols that are at the top, like Dopex, Camelot, Pendle, and GMX, Umami, Mux as well too. Those ones are all very Arbitrum focused, have been with Arbitrum since the beginning, and are not specifically cross-chain. So it seems that like if you've been in Arbitrum for a while and you've been building for a while and you've started to attract users and help Arbitrum grow, you're rewarded for that.
Yeah, definitely. That's it. I mean, in the absence of like a framework that the DAO has to use, everyone comes up with their own framework, and then obviously, ARB voting power generally is in the hands of Arbitrum native delegates, and they are obviously going to favor people that have enabled, and helped build the ecosystem. So currently we do have quite a top heavy distribution of ARB voting in these delegate hands. And to be honest, a lot of delegates and ARB votes falls within protocols themselves. So even just looking at the top, Dopex, Camelot, Radiant, GMX, Umami, Mux, Plutus, these guys, Jones, these guys all have quite a lot of voting power themselves.
Mm-hmm. Yeah, I mean, they were giving out the large airdrops from the initial from that initial like run that they had. That obviously helps, but again, they received those airdrops because they had attracted users from the beginning. They had built and they had been on Arbitrum for essentially becoming the incumbents on the system. I guess the people that are right around the cutoff. Well, I have two questions here. So first is it looks to be that the 50 million ARB that was laid out for this STIP grant, like the first round, is going to be fully used up. Like, what happens in the second round? Will there be any more ARB available?
I don't think so. No, the way it's laid out is there won't be any ARB left, or there'll be 140k of ARB left or something.
Yeah,
stupid. Yeah. No, unfortunately, we thought there might be another round 2 based on how slow what we were getting to quorum, but no, it doesn't look like that would be the case now. And we're essentially just going to have to run this STIP, collect data and analyze how we can improve these frameworks, and then we can have like a real grant program launch probably in Q1, Q2 next year.
Yeah, it's interesting how everything's played out. I mean, some of the bigger players, obviously Curve down here, hitting quorum but only getting 45 million votes. Wormhole, I know that you had been working on that proposal, and one of the reasons that had been given for, we can't actually see here. Let me just shift this. So Curve's down here at the bottom. One of the reasons I think that was given for Curve's lackluster success in this voting period was that they had received like 3.7 million ARB in the airdrop, but had yet to distribute it to their DAO members.
Yeah, I'm disappointed by the results. It's been a hectic few days trying to garner the support that we need, and it was a markedly controversial proposal, the Curve one. I saw a lot of support from some people and a lot of dissent from others, which is reflected in the voting. I think it's like a third for, a third against, and a third abstaining. But I think what we're going to end up doing is Curve has a lot of stockpile of ARB from the airdrop. So we're going to go ahead, I think, with the basic plan of the proposal, which is to deploy Curve USD pools onto Arbitrum and start incentivizing them with ARB to encourage migration of Curve USD over to Arbitrum. So that should be ready to go in the next, possibly as soon as in the next week or so.
And to chime in just a bit here, like one of the reasons that ARB had been sitting was awaiting the crypto 2swap pools to get through audit and officially get deployed and everything, right?
Yeah, there's a new stable swap implementation that has been in development. It's been going through auditing during the whole time that this proposal was live. So we did get some criticism that, oh, you have all this ARB that you've been sitting on and you haven't been using it, and it's like, well, partially that's because we have this blocker of getting this new stable swap implementation out before we can bring Curve USD over. So that's kind of what we've been waiting for. And as of my last conversation with the dev working on that, he says that that's going to be ready to go this week.
Yeah, I think. I mean, I don't think it's necessarily about using your ARB as incentives. Like, that's by no means will be what the community is asking you to do. It's more about probably having like a transparent roadmap about what that ARB's for. And even saying, hey, we want to use our ARB in governance, like no one's going to have a problem with that necessarily. I think people are more concerned that the fact that it wasn't publicized what you were going to do with it maybe, and the fact that, TVL and general activity and fees across Curve on Arbitrum have been historically low, that it looks like from the outside that curve isn't that invested in Arbitrum, unless maybe you're digging in the curve forums themselves.
Yeah, so I think moving forward, what we're going to do is like I said, we're going to start implementing the plan that I did lay out in the proposal, and hopefully that will end up demonstrating to the Arbitrum community that we are serious about migrating CurveUSD to Arbitrum and building building our ecosystem there. And then once you have this grant program deployed in Q1, Q2, whenever that's going to happen, then we'll come back with another proposal and say, like, look, this is what we've done in the meantime, and we'll give it a second shot.
Mm-hmm. Yeah, definitely. I think it probably can work out better for you. You know, obviously Curve's an absolute giant, and a DeFi OG, and there's no chance that the DAO's not going to support like a massive Curve migration to Arbitrum and support of CurveUSD and everything that brings. And if anything, rather than being rushed in this quick STIP, you can actually design a real long-standing proposal that lasts longer than 3 months.
So I was just looking at DeFi Llama right now, and notably, I just saw that the largest DEX on Arbitrum, which is Uniswap v3, is not taking part in these STIP grants. I wonder if that's a deliberate choice by the Uniswap Foundation, or just no one put up a grant proposal for them. But it's very interesting that they just didn't take part in this grant round at all.
Yeah, definitely. I mean, I have to say, I'm not close to anyone really within the Uniswap DAO. I'm not sure who has the authority even to do that, whether it is a DAO or whether it is Uniswap Labs. I know they are active on their own governance, and in fact, they've just had a vote around how to use their own Arb airdrop. They're running a automated liquidity management scheme with all the different ALMs, who manage the concentrated liquidity on V3. So, yeah, I mean, I think to be honest, it made things easier for everyone, I guess, without Uniswap there. I think they are much more operating now as a kind of, a decentralized base layer, and everyone else can kind of build incentivized products on top of that.
Yeah. So where is the, actually, Atomist, I want to get your opinion on this. Yesterday we had on Moon from Umami, and then the day before that we had Corey Kaplan from Dolomite, and we had spoken to both projects about how they were essentially taking the same route in how they were distributing the ARB as this OARB, which needed to be staked for anywhere between 1 day to 4 weeks, and then it could be purchased at a discount later on, and it also required the people receiving the ARB to also put up ARB as well too. And this, they hoped, would prevent any sort of mercenary dumping and hopefully keep users stickier to their platform. Do you think this type of system, which these two protocols are using, might become the schematic for how the rest of these, like the next season or the continuation of these STIP grants are going to be used, where it's not just outright, here's some yield that you can take and just dump it and hope you get users, but we want you to create a bit like a different way that people can come in and farm these tokens?
Yeah, definitely. I think, just as we've progressed like across the whole DeFi space in terms of how we deal with tokenomics, from simple farm and dump token to more looking at how we incentivize people to hold on for longer and, disincentivize dumping, it's clear that that's going to come into, all sorts of small mechanism designs like we're seeing here. Yeah, I think lots of teams will probably kick themselves for not thinking of something similar, but I mean, it's not that simple either. Both these teams are obviously having to, write new code for this. But yeah, I think next time you'll see people offering similar proposals just to kind of butter up their proposal. Well, but ultimately, we're going to have to review the data and see what happens with both these projects, and whether or not, they were able to, create sticky users, or whether or not, there will be a full analysis, I'm sure, of ARB that got distributed and ARB that got dumped, or ARB that got LP'd, staked, put as collateral. So, we'll have to see how that goes. It's interesting that came from two projects who are more kind of on the passive side, obviously a yield vault and kind of borrowing and lending. I'm not sure you'd get perp traders coming to, test out a new perp, and if they have to start, locking up their rewards and things like that. Maybe they would, but it's a different kind of audience, if you will.
Yeah.
So, Wormhole, this question is for you. As I was following through the kind of Curve grants application, I saw like a number of like very like odd arguments, let me just say, against it. And one of the, like, I won't get into all of them here for political reasons, but one of the ones that was like weirdest to me was when they were complaining that Curve hadn't been able to successfully retrieve its optimism grant. And I know you were also very involved in that process. I don't know like how much you could share, but could you talk a bit about like the saga of Curve's optimism grant?
Yeah, I had a feeling you were gonna mention that, because when I saw that one posted, it also gave me pause. I didn't want to really talk about that on the forums there. I didn't think it was an appropriate place to discuss that. Another grant on Arbitrum's grant.
I think you need a novel, probably.
So that the optimism grant was a very similar kind of situation that optimism delegates. Sorry, I have an ambulance going
by.
After
you.
It was a similar kind of grant situation. We made a proposal on the Optimism forum and we got approved. That was a similar grant where I was making it on behalf of Curve, which is a really interesting challenge because Curve is a decentralized DAO, and grant organizations have an aversion to DAOs, it turns out. I thought that might be the case, but I thought if we could convince them that we're credibly decentralized, then KYC wouldn't be an issue, but that was perhaps naive of me. As it turns out, KYC is a big issue. You always need to be KYC'd. And Curve could not KYC because you couldn't reliably get all of the key stakeholders of Curve together and KYC each and every one of them. So we had to come up with an alternative solution where Llamarisk could become the agent of the grant on behalf of Curve DAO with approval from Curve DAO to do so. We had to form a legal entity so that we could limit our own liability. And we deployed a pass-through contract that allowed us to receive the grant and pass it on to Curve DAO without being able to divert the funds. So we created this whole like on-chain and legal infrastructure just to be able to accept money from Optimism, which we have done, and we are in the middle of KYC. So it's been over a year now, but we're like at the very end of this saga, I think. So it's almost there, and it is going to be successful in the end.
Yeah, but the Arbitrum grant that you received like a year ago, like no such strings attached, right? Or difficulty, I should say.
The
no
Arbitrum
difficulty.
I'm not sure what you're talking about. I didn't receive an Arbitrum grant.
The airdrop.
Oh,
last Arbitrum airdrop.
So I don't know. I'm not a lawyer, so I don't know what the legal situation is, and I also don't know what Arbitrum's policy is about sending grant funds to a DAO. But my understanding was the airdrop was a little bit of a different situation because it wasn't a grant; it was a distribution of tokens. Perhaps in some kind of legal context, there's a distinction there. That was my understanding. I didn't ask questions. I just woke up one day and there was ARB in the Curve treasury, so I was like, oh, that's great.
Yeah, I mean, there was no requirements on the airdrop of any kind. You literally could do whatever you wanted with it. So the fact that Curve hasn't done anything with it is not a bad thing. Plenty of people sold their airdrop straight away. we've had teams buying back their own token with their airdrop. So it's not, there's nothing against what Curve's done at all. It's just probably the community wants to see, yeah, a direction, whatever that is.
And I appreciate your feedback, by the way. This is really helpful information.
So there's one other thing to talk about before we wrap up today, and that is the launch of sFrax or sFrax. sFrax went live last night with the new yield-bearing vault going up. It's the first part of FRAX v3. It's currently attracted 29 million FRAX in the past 24 hours, or not even that, like 12 hours. And it's currently yielding 9.4%. We saw some great posts from, I just had a, here we go. There's a nice post from Alunara, who talked about how they were very bullish about the upcoming combination of sFrax and Curve USD. And the idea would be that you would put sFrax in to Curve USD as collateral, and then borrow Curve USD against it, and then go loop it up for increased yields. So I think there was one comment that came in from, let me see if I can find this one. I'll find it here in a second, but essentially it was talking about how there were significant risks in this wrapping, and that there was issues with like Curve USD LPs as this wrapping grew. So Wormhole, maybe you could talk about this upcoming Curve USD integration. Have you looked at it all for sFrax, or sorry, sFrax?
Yeah, I'm sorry, I can't really give any input on this. I've seen posts about sFrax ETH, but I thought it was sFrax. Maybe I'm thinking
it is sFrax. Yeah, it is sFrax.
sFrax, yeah. I've seen posts about sFrax, but I haven't looked into it, what it is at all. So I can't really give any insight there.
Oh, okay. Have you been? Do you deal with Curve USD at all?
I would say somewhat. Yes.
Somewhat.
We look at peg keepers recently, because we've noticed that the peg keepers are a point of potential instability in the Curve USD system.
Mm-hmm.
So these are the pools that are Curve USD paired with other redeemable stablecoins like USDC, USDT, TUSD. That was the one in particular that we were looking at.
Mm-hmm.
I can talk more about peg keepers if you're interested, but I don't know if that's where you want to go.
Oh. Summarizing briefly Alunara's thread/post, basically, like, Alunara is incredibly excited about sFrax, which I'm sure, Sam, you could get into a lot more of the details about, like how sFrax works. But in particular, if this or SDI or other like real world asset T-bill tokens that are yielding the treasury rate got listed as collateral for Curve USD, then there's the possibility to essentially loop, get leverage, and instead of getting like the 5% rate, get something like 50% rate. So this is where a lot of the excitement's coming from, with relatively low risk of liquidation due to the kind of novel Curve USD liquidation mechanism.
Yeah, I mean, there's always instability that happens when you take on extra leverage like that. We can say that it's lower risk, but really the yields on that will be highly dependent on whatever the CRV USD borrowing costs are. And then,
which fluctuates, right?
Yeah.
Hit 10%, then you're in trouble.
Exactly. And then is there any like systemic stress that would happen if there had to be an unwind at any point? I think that's really the issue, is like what happens if you have like $100 million position unwind? Are the pools going to be able to facilitate that? Will there be significant slippage? Issues with the peg keepers as well too.
I have noticed. I think that interest rates on Curve USD spiked pretty recently, right? They've kind of risen substantially. And I think that's because of the peg keepers were finally completely drained. For a while there was some sticky peg keeper debt in the TUSD pool because TUSD was slightly under peg, and that was keeping I think 7 million Curve USD debt in the TUSD peg keeper. And when there's more peg keeper debt, it has a tendency to influence the interest rates to keep them lower. So TUSD finally went back to peg just the other day, and now we see that rates have risen several percent in the couple of days since then.
Yeah. Yeah, it's interesting. So FRAX came out with its V3 just a couple of days ago. You can go and read the docs. We'll have that linked into the description. They're going to be releasing this sFrax product. They're also going to be bringing on their FRAX bonds as well too, which will provide 4 years of bonds that essentially track, short-term T-bill prices for those dates. And then additionally, they're essentially doing away with the one-to-one conversion that they had offered before to be able to take one FRAX out and get like one USD back. You can still get one USD. You'll just have to swap through Curve. And this kind of ties into how they're setting up their new FRAX bond structure and also the state FRAX vaults so that they just algorithmically create new supply, and it's not really tied to anything except the balance sheet. So there's no expectation that the FRAX DAO has to do anything on the back end. The protocol is just going to work the way it is, and the DAO is responsible for trying to make sure that the balance sheet is always in the positive.
Can I ask you a question about this?
Sure.
I saw Stable Scarab on X was saying that the way that this works in particular is that FRAX put in 50K worth of rewards for the week. What are those rewards that FRAX is putting in? And then is like FRAX on the side, like investing this and collecting the 5% in a different account?
Yeah.
Like, how does this work?
Yeah. So the way that, okay. So just to juxtapose if you're going to be dealing with any sort of real world assets at all, you have to have companies or a company that is investing the treasury collateral into off-chain assets, which is typically short-term treasuries, T-bills. And so if you look at like Maker, they have delegated this out to a bunch of different like RWA investment firms who take their funds and then go put it into various bonds, typically short-term, and then return those funds back to MakerDAO. FRAX is doing it a little bit differently. They've set up one company, which is called FinRes. It's a public benefit company. And what this does is FinRes has one mission, and that is to essentially take the funds that are provided to it by the FRAX DAO and then go and find a yield with it, which will typically do by investing into treasuries. And so FinRes is able to take USDC and also Paxos. I'm sure in the future, USDC, and then also USDP, which is Paxos' stablecoin. In the future, I'm sure PayPal will be in there as well too, since it's a part of Paxos. And it's able to receive those stablecoins into its account and then swap those out for dollars and then invest it into treasuries so that it can maintain a positive balance, or so that it can earn yield for the FRAX DAO. And then all of those yields are then passed back to the DAO. And then the DAO has essentially like decision-making ability to determine where those rewards go and how they're distributed. And so with the sFrax vault, it's working similar to the way that the Maker Vault worked, where they're starting at a high yield at 10%, and then it will converge down to the IORB rate, which is like essentially the federal funds rate, which is about 5.4% right now, and they'll match that. So I believe up to $52 million, you'll have this yield that's above the IORB rate, and then after that, it will essentially flatline and stay there. And then hopefully they can grow it quite a bit. But it's been a long-needed product to be able to compete with Maker. and these other RWA platforms that are coming in. I think it's really interesting, and hopefully we see a return of growth to FRAX, which is taking a beating over the past year to its market cap, or not market cap, but like supply of stable coins.
Mm-hmm. We all wouldn't be here if we didn't enjoy the beatings.
Yeah, exactly. You know, I posted yesterday on my feed talking about this tangible thing in relation to stablecoin specifically, that the beatings will continue until we all get FedMaster accounts.
Wormhole, are we going to see a Llamarisk report
on sFrax?
Yeah.
I think definitely, yeah. We've been really interested in this trend towards real world assets. Pretty recently, we covered MakerDAO's increased exposure to real world assets in just a really short amount of time. I think it was in a matter of maybe 6 months or so. Their balance sheet became like majority composed of real world assets. And it's kind of amazing because a couple of years ago, I never would have thought I'd see crypto degens trying to flock to short-term treasury bonds, but this is the world that we live in now.
Well, here, I mean, look at this. So USDM Mountain Protocol went live. It's now live on Curve, and it's the first regulated and permissionless yield-bearing stablecoin on Curve Finance. So they have a gauge?
No gauge yet.
No, they haven't. We've been talking with them, and they seem like a good team. We're looking into USDM right now, and you can look forward to a report from us probably in a few weeks' time.
See, very I'm old enough to remember when USDM meant Mochi.
Wasn't Mochi where they took in like $50 million worth of CRV, and then it was just nothing? They had absolutely nothing, and they kind of like rugged within a week.
Their lending platform, they could use their native Mochi token as collateral, and they could set the admin could set the Oracle rate. So they could basically infinite mint USDM,
I remember that,
which they did to rug the pool, and they locked to their governance stake so that they could incentivize the pool to lure more LPs so that they could dump more into the pool. It was pretty brutal.
And then they bought $28 million worth of CVX tokens to start.
And shortly after, Convex blacklisted them, so they couldn't use their voting power on the platform.
Crazy stuff. Well, let's wrap up there. We're at the top of the hour. Wormhole, thank you for being here. Atomist, thank you for coming back second time. Really enjoyed the analysis.
Thanks for having us.
Yeah, thank you very much.
So everybody that is listening at home, make sure to subscribe on YouTube. Also, you can follow us on Apple Podcasts and Spotify. I believe we're on pretty much everywhere where you can get podcasts. So if you want to come and take a listen to us while you're like me and Garrett, like walking on the treadmill all day, you can definitely do that. Otherwise, we will be back tomorrow for the last day of the week. I'm sure we'll be talking about Arbitrum again. It's Arbitrum week. The votes will be wrapped up tomorrow, and we'll have a very clear understanding of what's happening with the ARB incentives. So thank you for being here, everybody. Garrett, always a pleasure.
Thank you. Thank you.
And
thanks, Garrett.
Yeah. And we will see you tomorrow.